Hi everyone, and welcome back to ACCA P4 live session revision number 3. Today the objective today is to look at a question on mergers and acquisitions and capital reconstruction and reorganizations. So if you go to your course outline, you will see the questions we are supposed to be doing today. So we're going to look at Marconi's Code, December 2013, and Doric Code, December 2010. Okay, I believe you can hear me clearly. Doric Code is a very big question, and Marconi's Code is relatively a small question. It's just a 25 marker question. Originally, I was doing pursuit, but the pursuit question is what is supposed to be the Marconi's question. I've just seen Ahmed saying, why are we doing the last sentence question? Okay, Ahmed, the last sentence question, the same thing is not coming, but the same principle is coming again. Marconi's Code, if you remember when we did the revision last time, we did pursuit code, and pursuit code's principle is what is used to do the Marconi's Code. So I'm going to use it to bring your mind on so many other things, okay? So mergers and acquisitions, the calculation questions are normally following the synergy or the maximum premium you have to pay, where we're going to say A plus B, AB should be greater than A plus B. It's the same principle. And given our restricted time, obviously we can't do the pursue that bigger question and Doric at the same time within the 2:45 minutes. Okay, so let's go straight to Marconi's Code. And then we take the question and we see what we can do about that one. So Marconi's Code, it is December 2013, question number 3. As usual, I will read the requirement and then I will know what I am expected of doing. So whilst I'm reading the main scenario, I will be able to indicate the important areas needed for answering the requirement. So the requirement A is estimate the additional equity value created by combining Novola Co. and Marconi's Co. based on the free cash flows to firm method. Comment on the result obtained and briefly discuss the assumptions made. 13 marks. How many questions do we see here? How many questions? I see 3 questions within that requirement A. You have to come out with additional equity value created using the free cash flow methodology, and then you have to comment on your results, and thereafter you would have to discuss the assumptions that you have made. So first you would have to dissect the question, divide the question into the sessions so that you will be able to answer all of them. Okay, so that is the A. I will need to use the free cash flow method to get the value created as a result of the combination. Then, as I was teaching, I told you the value created, the examiner can put it, calculate the maximum synergy, calculate the value of the synergy, calculate the maximum premium. All of them are the same questions. So what value are we going to create? The value we will create will come as a result of the synergy, the one company complementing each other. So that combination should create the synergy, and the extra value that we will create will come as a result of the synergy that the combination is going to create. So here your focal point is your AB should be greater than A plus B. So the moment I see that, I would have to what? Check the value created. This is my focal point. I would have to value A, I would have to value B, I would have to value A and B, which is the combined business. Which method I will use to value them, I cannot stand here and say it. It depends on the question in front of me. The examiner can tell you using the free cash flow basis. The examiner can tell you using the PE ratio basis, whatever. Okay, he can tell you to use the Black-Scholes option model, whatever the valuation methods that you learned. But typically, it is either the free cash flow or the PE ratio basis. Okay, so this is my focal point. I will need to get the value of the combined value of A separately, value of B separately. Okay, so that is that. The B is telling us estimate the impact on Marconi-Scholes equity holders if the premium paid is increased to 50% from 30%. So when we increase the premium that we're going to pay to take over the other company, obviously the value we will create for the shareholders of the predator company, which is Marconi-Scholes, is going to reduce. So that is the impact. Okay, impact here means you have to look at what is the current situation and what will be the revised situation. Currently, they said 50 from 30. It means if we are paying premium of 30, what will be the money or the wealth created for them? If we have to pay premium of 50, what will be the wealth created for them? That difference is what is the impact or the effect. Sometimes the examiner might say effect. Last one is estimate the additional funds required if a premium of 50% is paid instead of 30%, and discuss how this premium could be financed. 7 marks, all making the 25 marks. So let's read the scenario and then we come out with all the necessary point we need to answer the requirement. So please don't read it like a storybook. As I normally tell you, you would have to indicate what you need for the purpose of the requirement. So I'll start. Marconi-Scholes, a listed company producing motor cars, want to acquire Novola Co., an engineering company involved in producing innovative devices for cars. Marconi-Scholes is keen to incorporate some of Novola-Scholes' innovative devices into its cars and thereby boosting sales revenue. The following financial information is provided for the two companies: Marconi-Scholes, Novola Co., current share price, number of issued shares, equity beta, asset beta. Is something clicking? Equity beta and asset beta. Equity beta means it could be geared or ungeared, depending on whether the company is having what, debt or not. But when they say the asset beta measures only business risk automatically. So if you look at what the examiner has done here, so far as Novola Co. is concerned, its equity beta is the same as its what, asset beta. And what is the meaning? It means Novola Co. is not having that. Okay, then Marconi-Scholes, its equity beta is more than its what, asset beta, because of the financial risk implication. So whilst you are reading, you are making sense out of the question. My worry is what I keep telling you, go in there to read the question over and over. So the moment you start reading, then you are actually leading yourself to the requirement. It is thought that combining the two companies will result in several benefits. Free cash flows to firm of the combined company will be 216 million in current value terms. In current value terms, so this is my free cash flows. Okay, but these will increase by an annual growth rate of 5%. So I will say G for the next 4 years before reverting to an annual growth rate of 2.25% in perpetuity. In addition to this, combining the companies will result in cash synergy benefit of 20 million per year for the next 4 years. These synergy benefits are not subject to any inflationary increase, and no synergy benefit will occur after the 4th year. The debt to equity ratio of the combined company will be 40:60 in market value terms, and it is expected that the combined company's cost of debt will be 4.55%. The corporation tax rate is 20%. The current risk-free rate of return is 2%, and the market risk premium is 7%. it can be assumed that the combined company's asset beta is the weighted average of Marconi's calls and Novole calls asset betas weighted by their current market values.